Flashback a month and a half ago, December 15th. Volatility hitting rock bottom. The spike index bottoming out at 1122. A market dream, right? Well, guess what? Since then, the S&P 500 has climbed almost 6%, and volatility has also soared. The spike index is up 18% over that period. The VIX up over 11 over that period. Now, volatility haters are saying the VIX and spike index are broken. Are they distorted by 0 days to expiration options? Are they distorted by the massive flow into ETF shorts? Are they these ETFs? Are they distorting this volatility? Some think so, but volatility might be screaming a message. Now, remember 2022, the spike index hitting 40, almost 40 in March. Then there was a year of volatility declines, with the market also declining. Now, that was mean reversion, pushing us from the post-pandemic highs in volatility, the chaos that came with COVID, all the way back down. Now, the opposite is happening. We are in another reversion dance. Volatility is low, and volatility is yearning to find a higher center. Now, volatility isn't just a threat. It's an asset you can own. Unlike other investments, it doesn't guarantee long-term growth. However, just as I'm confident the S&P 500 and U.S. equities will be higher in 10 years, I'm bullish on volatility right now finding its mean. So stay tuned. We'll explore how we can leverage this in our portfolio. Plus, it's a crucial week. We have CPI and earnings this week. We have ROKU. I'll be trading that. I'll update you on Brian's Palantir trade from last week. And I have an Options 101 crash course you do not want to miss. Let's dive right into it. Economic reports for this week. It is all about the CPI. That is going to be the main thing. We really don't need much else on here. CPI is the only thing to look at this week for me. There might be some surprises, jobless claims, retail sales, some Fed speak, but the market is going to be all about that CPI this week. Investor sentiment. This is something, volatility. We talk about reverting to the mean. This is kind of crucial. This is something we pay attention to as a contrarian signal. Look at this, just this week after week, there are fewer and fewer bears out there. Look at how low this number is right here. Wow. So we're getting smaller and smaller. So just the potential here for something getting unwound here just continues to rise here. Another thing we like to talk about every week is the CNN Fear and Greed Index. Right now, we are at extreme greed. Now, does this mean the market's going to turn around tomorrow? Not necessarily, but it is something we should be paying attention to. Now, remember, last year right here, the market was hitting a high at the end of July, and it actually bottomed out right here. So we should be paying attention here. Now, maybe it's the case that this should hit a new high here before they turn around. We'll see. We'll see. Anything can play out. Now, we're also, when keyed in on these interest rates, the Fed has been setting these expectations. The market's not necessarily buying what the Fed has been saying, but we've actually moved a bit here on these year-end projections. We've come up, the baseline was kind of down here just a month ago. To be at 350 to 375. We are all the way up here, closer to 400 right here is kind of our baseline here. So we have moved in the Fed's direction. So the Fed's pushing the market still kind of grinding higher. And as we head into the big story, we want to think about this level. We got the higher market. Interest rates are kind of saying maybe that shouldn't be the case, and volatility is seasonally low. So let's jump into the big story. Of course, we talk about this seasonality effect of the VIX. It tends to rise at the end of February. It tends to rise. It tends to peak in March. So we'll be watching that play out. Now, here is one instance of a year where volatility went higher and the market went higher. This happened to be in 2007. We had, we actually did have a big dip here in 2007 in the market right at the end of February, something we should be paying attention for. Volatility tends to rise in March, remember. But we saw volatility going up and up and up. and as the market also went higher. And here's the VIX on the bottom here, just continue to rise higher. Now, what happened here at the end of February is the VIX found a new higher level here to kind of zero in here. So is that what we're going to be seeing now? Yeah, we'll have to wait and see. But it seems to be like the VIX found that higher level in February. We'll see if something plays out. Maybe CPI, some sort of a catalyst to get people to adjust to that feeling. So here's actually the spike index since December 15th. This is very, very classical. We got these higher lows here, higher low, higher low, higher low, higher high, higher high, higher high. Now, meanwhile, of course, we know the market's going higher, high, higher. So the volatility is undeniably in this upswing. It wants to find this higher range. It wants to break out above this 15 area because volatility just wants to revert to the mean. We go back over the past 5 years. Volatility just has this magnet towards the moving averages, has this magnet to want to go back to where we were. Now in COVID, that magnet just got extended. Like the volatility was just so high, the uncertainty was just so great during that period that we just saw higher volatilities. In 2000, the floor was above 20. In 2021, 18, 19 was like the very low end of the range. And it really took until the end, until 2023 to see that range cracked. And now we're kind of stuck in this lower range. So yes, in 2022, we had the opposite happening of the market going lower. We had volatility making lower highs. Now, people were saying volatility is broken, something isn't working. Maybe volatility was giving us a clue that 2023 was going to be a much different year. The Fed had it under control, or there wasn't any crisis looming. No, it's funny. We say that because, of course, there was that crisis in March of 2023. However, the Fed just jumped in and threw a boatload of stimulus on the pile. So maybe that's another thing volatility traders are kind of counting on now, that the Fed is going to be there. Will they always have the same types of tools available? I don't know. But that is another thing that the market just is kind of pricing in for good. Now, in my career, this chart is essentially my career. That's why I love this chart. This is the S&P 500 and the VIX since 2006. I was a former VIX market maker, a former S&P 500 options market maker. So, and this is the life that I have lived and chosen to live. But we know the market very clearly is a undeniable upward and to the right bullish trend. Now, volatility, it goes up, it goes down, it comes back to the same spot. But the other thing that happens with volatility is it's negatively correlating. So here's kind of the gist of what I think. I think volatility and just unlocking its potential is just this. So now we have volatility on the rise. Let's think about how we can weather this storm. Now, for the past couple of years, short volatility ETFs were just the investors' darling. They were fueled by falling volatility. The buy right and put right strategies offered a steady income, and they were like deflated tires in this climate right now. So they carry almost the same risk as equities, without the potential for high returns. Sure, they do have a place in a portfolio, but for true diversification, they're practically useless. Now, enter long volatility strategies, the real deal when the market gets bumpy. So remember how volatility reverts to the mean over time and how day to day it dances in the opposite direction as equities. That's the diversification magic right there. But hold on. Long volatility strategies aren't all created equal. Active managed ones for me are key. They allow for a built-in long short play, buying volatility while it's low, strategically selling equities while they're high. It's like having a financial shield that adjusts as the market adjusts. So if you're intrigued, I might just have the strategies you need. Feel free to head over to the equityarmor.com website, links below. Actively manage it. Long volatility solutions. Trust me, ditching these band-aids and embracing true protection will make you sleep soundly even when the market is throwing punches. Now, remember, volatility is not the enemy. We can use it to our advantage. Let's bring it into the trade ideas. Last week, we talked about Palantir. Here's the big earnings of the week, by the way. We have Shopify on Tuesday, Cisco Wednesday, Roku Thursday. I'm going to be looking at Roku out there. Last week, we did Palantir. Had a fantastic report. Just absolutely blew everything out of the water. Looking at this chart, this is from last week. We are trading, oh boy, all the way up here right now. So just absolutely crushed it, ended this higher range. So the trade for us last week was just getting in this call spread, 85 cents, $3 call spread turned into $3. So almost a 3-to-1 payout there. Of course, fantastic trade for us. Now, we talked about why using a call spread, it makes it cheaper rather than just buying the call outright. In this case, it would have been better just to buy the call outright, no question about it. But volatility was very expensive. That call spread was a lot cheaper because we sold the 20 call. Now, I'm going to be looking at Roku. Roku is kind of way off of its COVID era highs, but it's in a very nice trend lately. And actually, I'm looking at this very recent, just 1 month, very short-term pattern here. I think we have a bit of a head and shoulder bottom here. And that price target is about 10.5%. So from 95-ish area. So I'm actually going to be targeting 105 off of this head and shoulders bottom. And I will be buying the 98 call, selling the 105 call for $2.80. I'm looking for that to get above 105, obviously. Be a $7 call, turn $2.80 to $7. I would really love it if that happened. That would be just absolutely fantastic for me. So let's tune it over to you guys in the questions of the day. Hope everybody is enjoying the show. Hope you find this content useful. Please tune in every week at 1, and please ask your questions as they might come up. I got one here from Kyle. Hey, Joe, since the fear and greed index is hitting an extreme greed, does that mean the market is just about to crash? Yeah, that's a good question. No, it's just another index we like to look at. We are here in the extreme greed area. And of course, we have hit these extreme greed areas before, right before the market was about to have a correction. I think it's more of a sign, hey, things are getting a little cautious out there. It's just a sign that, hey, maybe we should have a little more protection than usual. Maybe we should be considering other options rather than just straight long. Now, that said, using some optionality for me is a lot better way to trade the market long right now, given the risks. Given that it's going up and up and up, we're at all-time highs in the S&P 500. There's no targets for me to look where an area where I'd want to sell at because we haven't been at these prices before. So using options would be the way to go. For me there. And of course, we can have a defined risk reward strategy on as we go. All right. Well, let's hope everyone's having a good time. Let's jump into the options 101 today. Options 101, how to turn a long put into a straddle. So remember, a straddle is a long call and a long put at the same strike. Well, when you're putting the straddle on, you're no longer a directional trader. You're a volatility trader. You're either looking for an outsized move or a smaller move, depending if you're long or shorted. So remember, a straddle is a long put and a long call. Put them together. It looks like a V. You're looking for a big move here. You want it to move outside this area here. And if you do it with stock, you can duplicate the same thing. Now remember, if you buy this long put and you sell stock, if you did this with 100 deltas, you'd actually turn into a long call. But if you do it with 50 deltas, Remember, an option is 100 deltas. If you do with half of the deltas, you'll only cancel off half of the position, and you'll get back to this long straddle position. Well, there you have it. Thank you guys so much for joining in. I'm Joe Tigay of Equity Armor Investments. This is Market Matters presented by Miax. Believe me, you guys mean the world to me. It really means a lot. We had a tremendous support last week. Really feels fulfilling when you guys show up and check out my videos like you do. So it's really helpful. Again, thanks again to everybody for joining in. Feel free to shoot me any questions, any comments. All that feels great. I love doing this, and I look forward to doing it again and again. For Equity Armor Investments, I'm Joe Tigay.